David Keller is with us, the chief market strategist at stockcharts.com. David, let's start with the S&P because it looks like right now 3,000 remains pretty strong. Yesterday I tweeted out a photo of the gladiator scene when they're in the form of phalanx, and they've got the spears out and nobody can get through. Is that 3,000?
It appears to be. I think that's a great visualization of what we're seeing on the charts. The fact that the S&P has tested that level a couple times, and it's not just the price support, that big round number of 3,000, which I think is a psychological level for a lot of people. It's also the 200-day moving average, which a lot of institutional investors sort of watch as a general barometer of where things are at. Are we above or below that key smoothing mechanism? And we've remained above it, and we've come down to it a couple times and have bounced up both times. I think the interesting thing about this week on a shortened holiday week, this is the type of week that I think satisfies everyone. If you're bearish, you see this as a easy counter trend rally bouncing up off the 200-day before a big break lower. If you're bullish, you see this as validation that stocks like Zoom and FedEx and others are able to continue to rally pretty well. I think what concerns me a little level below the hood is the breadth, and I think if you look at the breadth that things like small caps and mid caps in particular, they've come off a little bit. And while they're not dramatically negative, it's not like they're breaking down to a big way. And they came up a little bit yesterday on the nice rally. I think they'll be up again today if we continue in this direction. But overall, it's not screaming by. It's not telling you that the breadth is overwhelmingly positive. It's sort of flat to negative, so it's anemic is the way I would describe it more than anything.
So the other panels and the other studies that you have here, those are the advanced decline lines on the S&P. And what's the most compelling one? I mean, is it just showing that on a secondary level there's still kind of some churn happening within the market?
Yeah, good question. So I think a lot of people sort of get caught up just talking about the high level analysis, right? The S&P is doing what? And as we said, it's holding support, it's doing okay, but the levels below there, the panels below the S&P chart are the cumulative advanced decline lines on some of the major cap tiers. So it's the S&P 500 on the top, then it's the New York Stock Exchange, a broader universe, then the mid cap index, then the small cap index. And on an average sort of plain vanilla market top, what would happen is the breadth readings would start to roll over before the main index, and especially down in the small mid-cap space. And the reason being, as people get defensive, people rotate to the Microsofts and the Apples and the mega cap names of the FAANG trade that's done so well. The average stock already starts to break down a little bit, so the breadth measures will get negative. And then the very last thing to turn negative is usually the S&P 500, sort of that broader index, because the blue chips, the defensive names finally start to roll over as well. So it's not screaming negative, but it's right at that beginning point that I think you could look back to the last week and see this is where the breadth picture started to turn negative a little bit. So it's not on the S&P that I'd be looking. It's really on the bottom of that chart, which is looking at breadth in small caps and mid caps to see if they continue to break lower. Okay.
This is interesting now because it seems like we are at a little bit of a juncture, maybe not to over dramatize, but after bouncing off the level a few times for S&Ps, then we get this new potential support area formed. If that does indeed become support, that's a pretty high area, 3,000. I mean, I don't think a lot of folks really thought we'd be back here that quick to begin with, much less forming a base. For tech, we're kind of dealing with something similar. If you look at the NASDAQ, around 10,000, is that as important a level?
So it's amazing how there's this confluence of key levels. And again, when we talk as a technician, when you talk about things like 3,000 and 10,000 and big round numbers, that's actually been proven that price gravitates around big round numbers because psychologically that's where investors start to mentally revisit whether something is worth being above or below that key metric, sort of natural time to take a step back and reevaluate a position. So I think with the NASDAQ 100, with the NASDAQ composite, you sort of toying with that 10,000 level, which can be very, very important. What concerns me more than that is just what I'd call the bearish divergences on a lot of big technology names, and it's sort of that entire FAANG space. It's Amazon, it's Netflix, Microsoft, Apple, especially the mega cap tech space. All those big members of what you consider in the Qs, right? You have the higher highs in price over the last month or two, and then you have a lower high in RSI. And what tends to happen at a market top is the price will go higher. That last push higher, you actually get a lessening of momentum because there's less sort of push to get the price to higher highs, and that negativity, that sort of divergence of higher prices, lower RSI, often signals a topping pattern of sorts. Now, what I think of this is more of the leading indicator. This isn't telling you that the market has broken down. It's putting it on your watch list, sort of raising the red flag. So for me, I'm sort of caught as a technician between two opposing forces, which I think if you look at the economy, you have the differing forces as well. Is it everything's fine, we're reopening, we're holding S&P 3000, things are good? Or is it there are these divergences, there are these signals that the trend is long in the tooth, that stocks that have had a great run, things like the members of the NASDAQ 100 that have been consistent relative outperformers, at some point, the price doesn't go up in perpetuity, and things get a little exhausted. And I think the divergences we're seeing right now on the charts of the the mega cap tech stocks are the red flags, the leading indicators that tell me to be watching those charts for signs of weakness.
It's interesting, David, because even with the strength that we had, the frothiness on the momentum comparison to pre-COVID still isn't there. The RSIs that were elevated and above 70 for a long time, as we see on the chart, a lot of red territory there. Does that offer any countermeasure to the bearish divergences you're referencing? That, would it be even more bearish if the thing were just, bleeding hot RSI?
So you bring up a very good point, and the challenge that you have looking at momentum like that is in an extended uptrend. If you look at the cues over the last year, really leading up to this February, you can see that the market will become overbought and remain overbought, and that's what happens in an extended up phase, sort of that second half of 2019 into the beginning of 2020. The RSI on the big mega cap names became overbought. It just remains up there. A lot of times you'll also see stocks that become extremely overbought with an RSI above 80, which usually means there's such significant momentum that you have to assume that there's at the very least going to be further upside to alleviate that extreme upside momentum. So yes, I think that's one of the things you want to look for, and especially with some of these names that are bouncing so quickly, they will very quickly become overbought, suggesting they've gone too high too quickly. And what that means is, at the very least in the short term, you'd expect a little bit of a pullback to alleviate that, because it's gone too high too quick. It's sort of overshot sort of the equilibrium that it was aiming for. But what happens over time is the trend will form, and big mega cap technology names have shown that the market can become overbought, and that's actually a good thing. That just means it's gone up a lot. We always one of the slogans we would say, overbought means up a lot. It's not a bad thing that a stock becomes overbought. It tells you it's gone up a lot. But again, these divergences are just the beginning potentially of signaling some potential downside. That's why I'm watching those charts now.
Okay, speaking of up a lot, let's go to gold next. The breakout here has caught a lot of folks' attention again for gold. How compelling does it look to you? Can it last?
So it's so funny. I think a lot of times people get caught up in the narrative. We love to oversimplify, and that's okay. That's how we try to make sense of a complex world, complex markets. But I think a lot of times we get trapped into stocks are doing X, gold should be doing Y, and thinking of it as a simple mechanism with two levers and it goes one way or the other. Every time you show me where stocks go up and gold goes down, I can show you a different historical period where they went up together or where they went down together. I think you're best served as an investor focusing on the charts and seeing what the trends are actually telling you. If you look at the long-term chart of spot gold, it's in an uptrend. It continues to pull back and then focus on further upside. Now you're seeing the pattern in gold stocks actually set up really, really well. So if you look at the XAU, it's had this nice run up to the previous highs, long-term highs, multi-year highs, has pulled back to the 50-day moving average. And again, on average, a long-term uptrend that's pulled back to the 50-day moving average is sort of the sweet spot. I'd call that the fat pitch chart. The pitch you have to take a swing at, and that's what the XAU has done over the last couple of weeks. Now has returned back and retesting those previous highs. It's off a little bit today, yesterday, with the market coming off a little bit, and with some of the big cap tech names working pretty well today so far. But overall, I think it's setting up as another pretty decent long-term uptrend, and you compare what you see on the XAU with some of those tech stocks that are overbought, that are extended, you're not seeing that as much. You're seeing an RSI that's not overbought yet. So it suggests that there's room to run, there's further upside. So I could see as the S&P flounders, if it continues to retest something like S&P 3000, NASDAQ 100, we're sort of evaluating whether it rolls over. I could see something like the XAU just chipping away at an uptrend that people are probably not thinking about, and they probably should be.
I got to say, the narrative versus price for gold, it seems the clearest example of how important price is, because good luck with the gold narrative. It is tough. I've tried. It doesn't work. It goes up. It goes down for the same reasons, and right now it's just going up. So don't fight the trend, and more momentum ahead here for gold, I think, is a pretty good message, as that has been the message with continued highs. Speaking of tech, you've got an interesting suite of stocks you're watching. David, you call them the Mindful Six: Applied Materials, Morgan Stanley, Starbucks, Disney, Nike, and Cisco. I want to hit just AMAT here, but for those that are following your research, only 2 of them are below their moving averages, their long-term moving averages. The rest are higher in Applied Materials after this week's semi name. I want to get your take here. Does it look strong? Does it look like a trend that also is momentous right now?
It's a great question. I called this group of 6 stocks the Mindful Six, and this comes out of my own process. Every weekend I go through the entire S&P 500 stock by stock, and I do it by sector, by group, and just see what sort of themes emerge. Because again, a lot of times I think you can get caught up in just what the S&P looks like or what the Russell looks like. And if you look at individual names, you start to pick out themes and how different patterns are emerging. And I more often than not, markets will roll over. You'll see weakness on the individual stock charts before it's reflected on some of the broad indexes. And so for me, I came up on the last couple of weeks, this basket of 6 stocks. These are 6 stocks that, obviously all came down in March. They all rallied back to their 200-day moving average. Over half of them have gone back above their 200-day, but now they're sort of caught in that midpoint. They're caught in that range, just like the S&P 500. And my thinking was, if these 6 names are able to hold above their support over the last couple weeks or so, that speaks pretty well to the resiliency of equities. I wouldn't feel bad about owning stocks and expecting some further upside. But if one by one I start to see these names break down, it's just like a different way to measure breadth. You can see some weakness. Now, with semiconductors in particular, this is a key group to watch. It's sort of a bellwether group. And when semiconductors are doing well, the market overall tends to be doing well, and the opposite. When semiconductors start to struggle, it's sort of like a measure of the bedrock of the markets. And that doesn't speak well for the health of the overall environment. What's happened right now with Applied Materials, if I look at those 6 names and rank them in order of attractiveness, I'd probably have to put AMAT at the top of that list, because if you look since the March lows, it's just been this incredibly consistent pattern. Higher highs, higher lows. It hit its 200-day moving average. It broke right above it. It hit resistance around 54. It broke right above it, came back, tested the 200-day, tested 54, so now becoming support, and now breaking back higher. So a stock that continues to make higher highs and higher lows, in general, I'm going to be happy owning a chart like that, because that is the definition of an uptrend. The relative strength as well on a chart like Applied Materials has been really attractive. It's done very, very well and holding up really nicely at the same time. So Applied Materials is actually probably the furthest from its support level that I'd be watching out of all of them. Seems to be setting up pretty well, and I think that speaks to, again, when I'm looking at positive and negative signs about the overall environment, I think the strength of stock like Applied Materials would make you feel pretty good about
big semi
the legacy of the trend.
Big tech, biggest fabricator of semiconductor parts. Not bad to have that as a bedrock for strength. David, really good charts. Like the walkthrough here of where you see momentum in the market. Good stuff as always. Thanks for the technical look, David.
Absolutely. Take care, Oliver.
You got it. David Keller joining us from StockCharts.com.